Today in Trader Tip Tuesday, I'm going to take you through a recent trade that we did in sugar. This trade in sugar I'm going to take you through is a fantastic example of a culmination of all the concepts and all the principles that we teach coming together into one trade, where you'll be able to see as we go through bar by bar, day by day, week by week, what I'm thinking and why we manage to trade this way. For many of you, this is going to open your eyes to what is possible because what we teach is a very different way of managing trades, is a very different psychological mindset than you will see anywhere else. So with that, we'll get started. This trade that we did in sugar, it started off as an intraday trade. We call it ID1. ID1 stands for intraday one. It is the first time frame below daily. So this started off as an intraday trade that we identified that was backed up by a strong daily pattern. So we like to set up trades that combine multiple time frame analysis. So in this case, we're going to have an intraday support that's lined up with a daily support. And we're looking to go long at 21.83 with a 10-cent stop at 21.73. So this is on Friday, March 31st. So I'm going to hit play here, and you're going to see the trade start to unfold. And you can see the market comes down, we're filled. We're now long, and you can see the market then takes off coming into the end of the day. So we peeled 20% of the position that we bought intraday at intraday resistance. So we bought at intraday support, we peeled at intraday resistance, we took off 20% of the position, then we let the rest of the position run. Now, as we're running into the end of the day, it's a Friday. So one important concept here is that intraday trades, you have to be very careful. You can't really take intraday trades over a weekend because the great thing about intraday is we're able to go into sugar with a 10-cent risk. But going into the weekend, I have no idea where sugar is going to be on Monday. It could gap 40, 50 cents against me. I have no idea. So we're not willing to continue to assume that kind of risk. So what we do at the end of the day is we take our intraday risk, which the trade is working very well, and we roll it up to the daily time frame. This means that we're no longer going to manage off for intraday. We're going to manage off the daily. And it's a weekend, but I'm okay taking a daily risk over the weekend. Now, to further protect ourselves, what we're going to do is we're actually going to buy at the money puts. We're going to buy 22.25 puts, which will give us the right to sell sugar at 22.25. You can see right here, sugar's trading 22.26. So this means that at this point, I don't need to stop anymore because I have the right to sell sugar at 22.25 whenever I want. I'm protected. So my stop is gone. One of our key beliefs is that stops kill performance. So we use stops, but we're very selective and targeted about when we use them and how we use them. In general, we try and get rid of them. So in this case, we get rid of it by buying the 22.25 put. So now we're going to go into the weekend, long futures and long 122.25 put for every future we're long. This is what's known to be a long synthetic call. So we now have the risk profile of being long a call, but we legged into it for a big edge, making it virtually impossible for us to lose money on this trade. Okay, so let's finish out the day and see. Okay, and there we go. We close, and now we head into next week. Okay, so we come into Monday, we're long, we're hedged with the right to get out at 22.25, and we're going to let the trade work. So that's what we do. And we're going to see the trade unfold here through Monday. One of the things you notice when you actually see the market trade, you're going to see it breathes. It doesn't just go up. This is one of the things in trading. Everybody wants trades that just go up. It's not realistic. The market is going to oscillate. It's going to rally. It's going to come back. So this is what's happening. But our framework is telling us that we're good to be long. We have no sweat about being long. So now we're into Thursday, and you can see the market's continuing to rally. Now, Thursday is significant. You don't see it on this chart, but one thing that's happening on Thursday that's very significant is that we're breaking through monthly resistance. We're breaking through monthly resistance. So we're long the daily. The weekly now is moving higher, and we're breaking out on the monthly. So what this is actually going to allow us to do is it's going to allow us to roll our trade again. Remember, we entered on an intraday time frame and we rolled it to daily. Now, because we're breaking out on the monthly, we're going to be able to roll it to the weekly and let the monthly move protect us. So now we're time frame rolling this out to the monthly time frame. And let this keep going out to the end of the week. Here's Thursday. Now we're into Friday. We're a little bit off the screen, so I'll bring us down so you can see it. Okay, here we are finishing out the week, finishing very strong. It's been a big up week. Okay, so on this day, we roll up our 22.25 puts to 23.50. So we're going to buy the 23.50 put, sell out the 22.25 put that we were long. We don't need that one anymore. So we roll it up. So what we've done here is we've further protected ourselves. We now have the right to sell at 23.50, which is where we're at. So if we break, again, we don't need to stop. We're all set. And if we rally, we still have the chance for unlimited upside. Okay. So we roll up our puts to 23.5, and we've rolled the trade to the weekly time frame. So at this point, we're going to switch charts because we're not trading the daily anymore. We're trading the weekly. So we're going to switch charts, and we're going to go out to the weekly time frame. And here's our weekly time frame. You can see this is what we just looked at. The daily rallied all week. The week rallied. So we're about to finish the week. Now we're going to watch for the next week. And now we're into the next week. Now, one of the things we're seeing here is the market is starting to get overbought. It's starting to get overbought. So because of this, we decide to hedge the position by selling a near dated call spread. We sell the 24.25, 25.25 call spread. We're selling this call spread because it's going to give us, we're going to collect premium, which is going to help offset the cost of our put. We still maintain an unlimited upside because the call spread has a limited loss, while our position, which is long futures and long puts, it's a long synthetic call, has unlimited upside. So we have a position has long unlimited upside and has limited loss on the hedge. So if we keep going up, the hedge will max out and the market can keep going. But we're collecting extra premium that helps pay for our puts and sets us up in a position that we actually continue to make money. If we rally, we actually make a little bit of money if we sit, and if we break, we're out. We're out at 23.50. Okay. So right here on April 10th, we sell this call spread. We sell the 24.25, 25.25 call spread. Okay. Now we'll let it continue to go again. Now on the 11th, this is the 13th. We actually missed on the 11th, right in here, when we got up in here. In addition to selling the call spread, the other thing we did is we took our 23.50 puts and we rolled them out. So we were long 23.50 puts. We rolled them out a month, which gave us more protection, more coverage. So now we're short a short dated call spread and long a further dated put. So now we're collecting theta while we're sitting. We can still make unlimited upside if we rally, and we're out at 23.50 if we break. Well, the thing I want you to notice through this is we're going through this position. We're always in a position of strength. If the market has a sharp correction, we don't care. We don't need to stop. We don't have to overanalyze. Everything is being taken care of for us as we go. Okay, so let's keep going here. Okay, now we've come to the end of the week. We've come to the end of the week, and our 24.25, 25.25 call spread is expired worthless. It's worthless. So we collect the full premium that we collected when we sold this call spread. we collected 14 cents. So we sold them 1-to-1 for every future we were long. We sold one call spread. This helped offset the price of our put, which the put we were long, we paid 46 cents for. Okay, so this helped offset the price of our put. It's gone out worthless. So now our upside hedges are gone. We're still long a 23.50 put. And now what we're going to do is we're actually going to sell the 24.5, 26.5 call spread. So we're going to sell basically just above the money, and we're going to buy a call spread above. We actually do that. Yep, we do this on Monday the 17th. Okay. So now we're going to hit play, and we're going to let it go again. So we've got a call spread above hedging us. We're long puts below. And this trade, we're good if we break, we're out. And if we rally, we're going to make more money. Okay, now we're coming to the end of the week. We've come to the end of the week. And now everything is good. Nothing in our method has told us to change anything. We're still letting the trade just run. Okay, so now here we go. You can see sugar takes off again. And now it's both here and here. It hit what we call a breakout target. This is a target where the market has essentially gone too far, too fast. So when we hit these, we like to hedge. So at this point, we're actually going to roll up our 23.5 puts. We're going to buy the 25 put, sell out to 23.5 put we're long, and we're rolling up our exit from 23.5 to 25. Okay, so we're short a 24.5, 26.5 call spread, and we're long a 25 put. Now, the call spread, we're already through both strikes. That has a max loss. So now we're through 26.5. So now we're back to fully long. We're hedging this fully long with being long the put. And if we break, we can still make money in the call spread. So, all right. What day is this? This is the 25th. Yep. Okay. And the 26th, which is the next day, in here, we roll up our put from 25 to 26.5. Because we're in a breakout target, we're concerned that we could sell back off. So we're rolling this up so we know we're out at 26.5. So we're long a 26.5 put. We're long a 26.5 call. We're short a 24.5 call, and we're long futures. This is our position. Okay, so we bought the 26.5 put, sold out the 25 put we're long, and now we have this on. It did miss one thing right here on April 12th when we hit this breakout target. We actually sold futures here and bought the futures back in here. So we had what's called a gamma scalp. We sold futures out, we bought them back. That was it was a 69 tick scalp. We sold 24.79s, bought 24.10s. Okay, so now we're long a 26.5 put. We totally have everything covered, and let's keep going. Okay, right here. May 2nd, we're going to go into May 3rd. May 3rd, right here, we actually buy back, we buy more futures. We're able to do this because we're long 26.5 puts. So we buy futures against the 26.5 puts, helping us to get longer on a pullback. Okay. And the market is short-term oversold in here when we buy these futures. And you can see the market starts coming back. Then we sell these out, sell out the futures that we bought. And we let it go through. This is now on the end of the week. And at the end of the week, we basically flatten up the position. We do this. We buy a 24.5 put. By buying the 24.5 put, we did all this actually. Yeah. By buying a 24.5 put, it neutralizes the short 24.5 call that we were short, creating a short synthetic future. So we have a short synthetic future against long a future. That left us essentially with a 26.5 straddle. We basically traded out of this, putting ourselves in a conversion reversal. So the position now has no risk on, it's neutral. So we're essentially out at 26.44. We've neutralized the position. We've taken everything off. What started off as a 10-tick risk ends up being over a 21R winner. Yeah, over a 21R winner. It's awesome to have a 21R winner. There's no doubt about that. Most of you have never had a 21R winner. So that part is super cool. But what's really lost in this is something that's actually much more important than a 21R winner, which is a lot of times to get a 21R winner, you got to take a lot of risk, a lot of open risk. This is why people don't get them. They get too nervous about all the open risk. But what I want you to see in this example is that because we kept owning these at the money puts, we never needed to stop. We never had to worry. If the market corrected, it was no big deal. And so as a result, we actually had very little open risk on our way to making 21R. Most people cannot say that. So you saw, let's look at the different things we did here. We did a time frame roll where we bought an ID1, rolled it to daily, rolled it to weekly. We quickly hedged it with options to get rid of the stop, and we never needed to stop again. We sold upside call spreads to collect premium to help pay for the put that we purchased, so we didn't need to stop. But we sold call spreads, not calls. By selling call spreads, it allowed us to preserve unlimited profit potential if the market continued to rally. We saw one spread we sold that went out worthless, and we were able to sell another one to replace it. And that spread, the market actually ran through both strikes, making us fully long as it ran through both strikes. So many cool things in here. And one of the things you could see is what backed all this up is what we call the method. This is a technical framework that I built that really looks at understanding value and how to trade around value. And so we got long in value, and then we essentially hedged anytime we got too far away from value at these breakout targets. Then we could reinstate, which we did here, when we came back to value, and allowed us to do what pro traders do, which is they trade around the position. When the risk really starts to take off, when the profits start to take off and so does the risk, they sell some off. Then when it comes back in, that allows them to buy some back. They're always in a position that they can respond by their own choice, never forced to do anything. And that's what we really did in a sugar trade. A lot of things I said in this video are probably somewhat advanced for you. That's okay. I would actually encourage you to go back and watch this again. There's some phenomenal tidbits in here that could really help you take your trading to another level. That's what Trader Tip Tuesdays for, is helping you take your performance to an elite level. These are the type of concepts we're going to teach in the 300 Summit. We're going to go through method level 3. In method level 3, we're going to talk about some of these patterns that we've seen. We're going to talk about rolling timeframes and how do you know when to roll. We're going to talk about how do you think about stops. And then we're going to come into options 301. In options 301, we're going to learn how to get rid of stops. We're going to learn to always have our risk hedged off so we don't need stops. Then we're going to build on using advanced strategies, knowing when to use a call spread versus buy the put, understanding how to roll these, understanding diagonal calendar spreads, understanding when volatility's gotten too high and it's going to pull back, or when volatility's contracted and has reset itself. These are things that we're going to teach in the 300 Summit. It's going to be a professional summit unlike anything you have ever seen. You'll never go anywhere and be taught these techniques in this level of detail. The kind of thing that allows you to be set up as an elite hedge fund manager would trade or an elite prop trader would trade. I know this because I have taught them and I have worked with them. I know what they do, and they do not do this. Very few of them do this. You'll have the chance to do it. We're going to get to do it in person in Chicago. I look forward to teaching these with you and helping you take your trading to a level that you never thought possible. Make sure you sign up now. Looking forward to seeing you.